Hey, welcome to Options Brew TV with our midday market shot with Mark Phillips from Harvested Financial. I think
Hey,
Mark's
Lex, how
got,
are you? Good to see you
hey,
again.
Mark, how you doing, man?
Doing good, doing good. It got freezing here in Chicago this week. I don't know what happened.
Yeah, we were talking pre-show, Mark and I, and I noticed he had his kind of his fall / early winter, fleece on, right?
That's
So
what we got to do here. You got to get the
yeah,
quarter zip going, and Chicago winters, your falls, I should say, that like you're in your t-shirt last week, and then all of a sudden you're in your quarter zip this week. So
right. And we discovered 35-degree drop in 24 hours in Chicago. It went like from what 75, I think it was, to 40 overnight, 24 hours.
24 hours. So it
Crazy.
keeps all the traders inside during the winter.
That's right. Thank God for the screen, man. All right, good. Well, welcome. What are we going to do on this cold Chicago day? What are we talking about, man?
So I wanted to go through some income strategies here, actually, and like kind of break down sort of the way we think about setting up an income strategy trade.
Okay.
We often get requests from our clients that want to say like, oh, I want to generate some income with options, or I'm long this stock, and how can I do something with options here? So I want to kind of break down a comparison of how we think about it, the different factors that go in, and compare a couple of interesting names and see how just writing calls really differs across different names and volatility structures.
Okay, let's do it. You're sharing?
Yeah, let me pull up my screen share here. So,
Okay, good deal.
you know, got
So
trade
when you say, oh, there we go. When you say writing calls, again, I've got to be the, I'm gonna pretend like I don't know what you're talking about. So writing calls, right? That means you own stock, or you've owned stock, or you're buying stock, and you want to sell a call against that stock to generate some income, because that call selling it's going to decay, and that's the kind of the idea, right?
exactly.
Okay,
So it's a position where you are long the underlying and you are short the call against it.
got it.
Typically an upside call that you would sell against it, like you say, to capture that premium. But one of the things that's really nice about it is defined risk. So even though you're only selling one option, the way your stock position acts against that is it does cap your upside. So that strike price sort of acts as a takeout level that
Got it.
you're willing to say above this price, I sort of go break even at that level.
Okay,
And actually,
great.
I'll pull up a chart because that's a great way to look at that and see kind of where that happens. So,
Okay.
I've got Apple pulled up here.
Yep.
So Apple's trading around $120 right now, as of the close. So if we're gonna go and sell a call in Apple right now, I'm looking at the December 18th expiration. So that's a serial expiration in December. If I go to the 125 strike, so the 125 strike is actually, let me pull up my annotator. The 125 strike. Oh, you got me right there. So the
Oh, you got it. Go
125
ahead.
strike, about $5 out of the money.
Okay.
We can also see that that's a 35 delta here.
Mm-hmm.
So delta again, one of the ways you can think about it is the probability of the option closing above that level.
Okay.
So one way to think about that, and one way to think about parameterizing a strategy, would be to say, sell me the 35 delta calls in Apple every month or every week. And one of the benefits of parameterizing by delta as opposed to just by a dollar price is you get some flexibility there. That as the volatility changes, the deltas are going to change. So you're naturally adjusting to the market levels with your strike selection here by selecting based on delta. So that's a really interesting feature of using the options pricing model,
Okay.
for strategy selection.
Is there a favorite delta that you use, or not? Is it depend on the stock? I know you mentioned implied volatility. I know that's going to change the delta of these options, but is there a favorite delta per se that you like to look at?
We typically go out of the money when you're writing a call, of course, so anywhere below a 50 delta generally, but we find it really depends on, sort of what someone's looking for. If you
Okay.
go for a much lower option, of course, you've given yourself a lot more room for that stock to run. If you're going to go for something tighter to the money, you're going to collect a lot more income, and there's going to be a lot more of that sort of premium on those at the money options. We know those Greeks are the highest at the money. So you do collect that extra premium there, but you have a pretty low takeout level.
Got it.
And actually, we'll see. Let me turn off my annotator. We'll see that if we were to sell this 125 call here, and then I'm going to add the stock component and throw it into the what if over here.
Okay.
So
Okay, that's a good graph.
we see this exactly. This is a great graph actually. So we see this nice, straight line that looks very much like stock.
Mm-hmm.
If Apple stock goes down, you start to lose money just as if you own the stock. So this is a great kind of entry level options position because it behaves pretty similar to the way it would with owning the stock.
Mm-hmm.
But then above that strike price, above that 125 strike price, it goes totally flat.
Okay, I'll just outline it for the folks so when they're viewing this, they can see it. So right there's where you're talking.
Exactly. So above that 125 level, we're going to plateau. And for every dollar the stock goes up, our options contract is going to lose $1, but we make it in the dollar. So, or we make it in the stock. So we're completely flat above that level. And that's why we sort of refer to it as the takeout price.
Yeah.
So a level, you might want to set that at a level that you're comfortable selling the stock. But back to the delta question, right? Like if you sell that really close to the at the money, that's actually what a lot of the buy right indexes replicate. You tend to see a lot of choppy returns. And so like in many ways, a lot of the returns in the equities market come on big up days. I think there's some fantastic stat about if you miss the top 10 biggest days in the market over the last 100 years, your annualized returns drop by 25%. So that, really giving up that upside can be, there can be a lot of FOMO there. So, depending on your sort of risk tolerance, you might want to set that tighter or less tight.
Okay, let me ask a few questions. Okay, so the folks might wonder, well, wait a minute, this looks scary to me, but I just want to reiterate, you already have the stock position. You've already made that choice. You've already made this kind of an investment, right? It's stock. So that's what stock looks like, at least that part of it, right? So you're in this case, Apple, you're in it for a reason. You believe it's going higher. But what you've done is, and again, correct me if I'm wrong, you've enhanced the income of the strategy by selling a call against it. And at some point, and that we know what that strike is, you already showed us, you're going to start flatlining, right? And you're at 1-to-1, stock going up, short call going up the same amount, therefore offsetting each other, but you're making that premium is the difference. And that's that income part of the idea here. Is that right? Sort of.
That's exactly right. I think, and like we like to think of that income as it's almost a trade-off, right?
Yep.
So you're collecting that income now in exchange for foregoing potential upside in the future. This isn't free money. This isn't just free money that you can get from selling calls and with no potential downside. It comes with a trade-off. It comes with that trade-off of foregoing upside above that.
Okay, I got it. Yep. And then let me ask you another question. Do you ever let if all of a sudden Apple, expiration time trades somewhere up in here, are we letting the option expire, in which case we'll be assigned? So on a 1-to-1 basis, we're long 100 shares, we're short one call. That's going to net out to zero. We no longer have any stock. Or do we roll this position into, eternity every month or every monthly expiration cycle? What is there a thought there?
Yeah, there are a lot of thoughts. And again, I think it comes back to individual preferences.
Okay.
So in some ways, taxes are always an interesting question when it comes to investment. So of course, like to the extent that you're getting your stock called away and sold, like there might be tax implications there. However, certain clients tend to use this as a divestment strategy. It's a nice way to structure intentional sales of your stock. So if you are trying to roll out of a position, you might want to let that get called away.
Got it.
On the other hand, if you're using this as an income generation strategy, if you continue to be bullish on the equity, rolling that forward and allowing you to capture more premium in the next further out month, does keep you continually exposed to that. And we really like continual exposure to sort of a systematic strategy execution. So for the vast majority of situations, we are rolling that forward.
Got it. Okay. And sometimes you might be, if the stock behaves well, it moves up toward that strike, you might be rolling it to a new higher strike, the new 35 delta, right?
Exactly. You can roll both within the same term. You can roll up to a higher delta, roll up to a lower call delta, or you can roll across the term structure.
Okay. Awesome. Okay, great. That looks fantastic.
So now let's compare. So Apple's a pretty common name. Everyone, knows what Apple does and probably has a phone somewhere in their history. But let's take another name and just kind of compare, the prices that you're actually going to receive on these options. Like what kind of income numbers are we talking about here? Mm-hmm. So, I had us selling that 125 call in Apple at $2.56, somewhere around $2.50. I'm going to pull up another name, Beyond Meat, another relatively popular name here. And the reason I pick it is because its stock price is relatively close to Apple's. So I want to sort of compare two securities that are going to have similar, fundamentals to them.
Okay.
So I should say pricing, not necessarily volatility, because volatility is the one that we're going to look at. It's very different here.
Right.
So Apple was around a 34 vol here. Beyond Meat's trading almost double that at a 58 vol in December. Okay. So how much does the price of that volatility impact the options price? Well, we'll see quite a lot, because the 35 delta call, actually it's a 37 delta here. I guess stock moved a little bit on me. But the 35 delta call right here, 37 delta call, is trading for 548, or we have that worth $5.48. Mm-hmm. So significantly more. And we can see that really with that increased volatility, the same delta of option and the same sort of risk characteristic probability of it hitting that is mm-hmm. trading for almost twice as much, more than twice as much. So volatility really has a big impact on the pricing of the options, of course. And that should play into selecting a stock when you want to pick your covered call strategy. Mm-hmm. That there are certain names that might be more or less favorable depending on their volatility levels. So
does this higher volatility make me happy or sad or scared or not scared? Or not, none of the above. I mean, I get more money, but higher volatility means, oh my gosh, this thing can go anyway, you name it, right?
It can go any way, you name it. And that is an element of trading the higher volatility names. But volatility goes both ways. So you're collecting higher premium, and that has just as much of a chance of going down. And so that's kind of that compensation there. Sure. You'll notice too that I think BYND is trading around 129 right now. This would be $12 out of the money. In Apple, so back of the envelope, that's a little under 10%. Apple, we were only about $5 out of the money. Right. So the percentage moves are also going to be much bigger here. That we're looking for a 9%, 9.5% move in BYND before we hit our takeout level. Whereas in Apple, we were only looking for a 4% move before.
Got it. So with the higher volatility, implied volatility, and BYND, is there any thought to choosing a higher call strike, a less delta, even with a premium that's better than Apple's? Does that ever come into play at all, or not really?
Sure, you can absolutely think about that. And I think an interesting comparison is actually if you go all the way down to the 155 strike in BYND, or all the way up, I should say, that's where you get that premium that's pretty similar to what you collect in Apple, that 250. Yep. So that's almost a $25 move, or a little more than a $25 move in BYND to collect that same amount of premium. Got it.
Okay. Yeah, that's quite a difference, right? That's a great comparison. So the folks can see how that implied volatility plays into this. That's excellent.
Yeah, and I think so. Here I compared two different names that were about the same dollar price, but we'll just see when I pull up Tesla how impactful that dollar price really is. Okay. And Tesla's kind of an interesting name because, as a little bit of a cult name, almost I'll call it, there are a lot of, devout Tesla stock owners. And so there are a lot of, people that are long-term bullish on Tesla, but they want to think about, how to handle and manage a lot of the volatility in here. Mm-hmm. So Tesla's around the same vol as BYND Meat is around 57 or 58. So if you're holding a 58 vol stock, you might want to think about some other ways to potentially monetize that and, buffer your overall position by trading options around this.
Okay.
So if we look in Tesla,
these are big numbers, Mark.
These are big numbers. So go down to 35 delta. So 35 delta in December 18 is the 450 strike. Okay. So that's 12% out of the money, and that's a $16 option almost right there.
Okay.
So triple what you were collecting in BYND and 7 times what you were collecting in Apple.
Wow.
For a $50 move, or I should say $38 move.
Right.
So those are big, expensive options. It's a $412 stock right now. And so those options are going to be correspondingly expensive. And with the higher volatility, they're going to be even more expensive. So it's interesting for long-term holders of Tesla to think about writing options in here to manage that volatility. And you can really kind of buffer your overall portfolio level by selling covered calls and rolling them forward, potentially rolling them out as the market does move. So that high volatility does present a really nice opportunity to really manage a position you might already want to be in anyway.
Right. Wow. That's a stark comparison, right? Those are some big options. I'm just looking at the board now as you show it. I'm looking at the straddle, the 410 straddle. Whew.
Oh yeah, almost a $60 straddle right there. That's pricing some pretty heavy moves here, and Tesla moves. We know that. I can actually pull up a stock chart here. But oops, I keep.
Yeah, get your right. Is this the implied vol chart?
Yeah.
Yeah. So this thing's all over the place. Hit go here. Hit close to close as well.
So we can see the historical.
Yeah, then I think, and then go ahead and choose your month. What do you want, a 60? There you go. There we go. So these points are 0 points. Those are just bad data points. But otherwise, if you kind of can imagine those not being there, you can see the curve. I'm gonna let you talk about it, but I just want folks to see where we are. This is the implied volatility curve. Okay, the one I'm drawing here. Fortunately, I chose red, which is also the close to close volatility there, which wasn't very smart of me. But you can see where that implied volatility's been, right? And you're going to talk, I mean, this is COVID, right? Crazy numbers. You can see the scales on the side. So in volatility terms, those are gigantic. We were just talking about a 57 vol. These are 120, 130 vols on the left side there.
Oh yeah, we're at the relatively low end of the range in Tesla and in the market, of course, overall. We had that little hump here in terms of the election, but Tesla's implied vol has been all over the chart. I mean, in the hundreds, those options are getting real meaty on a $300 stock that's trading 120 vol.
Wow. And you know what the funny thing is? It feels like how can you go wrong selling premium in Tesla when it's 130 vol? Well, guess what? You could.
Yeah, you you buy high vol so you can sell higher vol.
Right. That is something. But yeah, you're right. Relatively, I mean, I'm guessing if you go, do me a favor, if you go 2 years here, see if we can do that. Let's go out 2 years. Okay, perfect. Again, avoid the 0 points. But back way before COVID, I'm drawing the line at 50-ish on implied on a 30-day option, more or less. That sound about right? That's where kind of, Tesla's sort of simmered. Maybe it's here. I mean, I may not do that so well, but somewhere in there, it's called 50, 55. I mean, these are gigantic numbers, and we're starting to head back toward that number today, right? After all this stuff, we're getting back toward what over 2 years is probably about right for Tesla implied vol, huh?
Exactly. And I think you sort of start to see that like over at this, and with this red line coming in so much, that historical close to close vol is just really coming down quite a bit. And you can see it in the stock price chart. We're just, fewer tweets out of Elon, and all of a sudden the stock calms down a little bit, I guess.
Yeah, right. We only need one good tweet, and all of a sudden, guess what's going to happen to this stuff? Boop.
Well, that's why we like a nice defined risk play. So we wouldn't be selling these calls naked. We'd certainly want to have like a stock component underlying that.
Awesome. Good stuff, man. All right, good. So that's our show for today, right? Our little market update. I love it. Very cool. Appreciate it, Mark. Terrific.
Yeah, thanks for having us. Always great to talk about income strategies and ways to manage stock positions you either want to enter into as a long-term investor or ones that you might already have.
Right. So just a little plug here too. That's great. Mark and I are going to be moving this to a regular show. We're going to invite some guests. So look for that. We'll give you more details, but we're just going to put it out, to think about it right now. And we're going to have always some different ideas to talk about, some great option strategies. Look for Mark, Harvested Financial, great partner of Trade Ears. So, and we love talking to Mark on Thursdays and on Option Brew. So thanks, buddy.
Good to see you as always.
Awesome.